Market crashes can shake your retirement plans. Let's explore how to adjust strategies for stability. Market crashes can shake your retirement plans. Let's explore how to adjust strategies for stability. To understand how to navigate these turbulent waters, we first need to grasp what a market crash really is. A market crash is a sudden, significant decline in stock prices, typically defined as a drop of 10% or more in a major index within a short period. These events are often triggered by a combination of factors, including economic downturns, geopolitical tensions, or even investor panic. Historically, they have led to widespread financial distress, impacting not just the stock market, but also the broader economy. Looking back, we can identify several notable market crashes that have shaped the financial landscape. The Great Depression in 1929 is perhaps the most infamous example, where the stock market lost nearly 90% of its value, leading to a decade-long economic slump. More recently, the 2008 financial crisis saw the S&P 500 plummet by over 50%, wiping out trillions in retirement portfolios. Each of these crashes serves as a stark reminder of the volatility inherent in investing and the potential consequences for retirement portfolios. The characteristics of a market crash often include rapid declines in stock prices, increased trading volume, and heightened investor fear. During these times, many investors panic, leading to a rush to sell off assets, which can exacerbate the downward spiral. For those relying on their investments for retirement, these crashes can have devastating effects. Retirement savings can be significantly reduced, forcing individuals to reconsider their plans, delay retirement, or even return to the workforce. In summary, understanding market crashes and their historical context is crucial for anyone planning for retirement. Recognizing the signs and knowing how to respond can mean the difference between financial security and uncertainty. As we move forward, we'll discuss actionable strategies to adjust your retirement plan during these challenging times, ensuring you remain on track despite market volatility. To effectively adjust your retirement plan during a market crash, the first step is to assess your current retirement plan. This isn't just a routine check, it's a critical evaluation that can safeguard your financial future. Begin by taking a close look at your existing asset allocation. Are you heavily invested in stocks, or do you have a balanced mix of bonds and cash? Understanding where your money is currently allocated will help you gauge your exposure to market volatility. For instance, if your portfolio is primarily in equities, a market downturn could significantly impact your savings. Next, evaluate your risk tolerance. This is essential because your comfort level with risk should dictate how you adjust your investments. Ask yourself, how would I feel if my portfolio lost 20% of its value? If the thought makes you anxious, it may be time to reconsider your allocations. A common approach is to align your investments with your age and retirement timeline. For example, younger investors might afford to take more risks, while those nearing retirement should prioritize stability. Now, let's identify any vulnerable areas in your retirement portfolio. Look for investments that have underperformed or sectors that are particularly sensitive to economic downturns. For instance, if you have a significant portion of your portfolio in travel or hospitality stocks, these may be more susceptible to market crashes. Diversifying your investments can mitigate these risks. Consider reallocating funds to more stable sectors, such as utilities or consumer staples, which often perform better during economic downturns. In summary, assessing your current retirement plan involves a thorough evaluation of your asset allocation, understanding your risk tolerance, and identifying vulnerable areas. By doing this, you can make informed decisions that will help you navigate market crashes more effectively. Remember, the goal is to ensure that your retirement savings remain secure and continue to grow, even in uncertain times. Take action now to protect your future. When a market crash hits, it's crucial to have a game plan for your retirement savings. The first step is to rebalance your portfolio. This means taking a close look at your current asset allocation and adjusting it to align with your risk tolerance and investment goals. For example, if stocks have taken a significant hit, you might find that your portfolio is now more heavily weighted in bonds or cash than you intended. By selling off some of those safer assets and buying stocks at a lower price, you can take advantage of the market dip while reducing your overall risk exposure. This proactive approach can help you maintain a balanced portfolio that aligns with your long-term objectives. Next, consider diversifying your investments into safer assets. In times of volatility, it's wise to spread your investments across different asset classes. For instance, if you primarily invest in equities, think about allocating a portion of your portfolio to fixed income securities like bonds. Bonds tend to be less volatile than stocks and can provide a steady income stream, which is especially valuable during uncertain times. Additionally, you might explore investing in commodities or precious metals, which often act as a hedge against inflation and market downturns. This diversification can provide a buffer against losses and help stabilize your retirement savings. Another strategy is to explore alternative investment options, such as real estate. Real estate can serve as a solid investment during market downturns, as it often retains value and can generate rental income. If you've never considered real estate before, now might be the time to research real estate investment trusts, REITs, or even rental properties. These options can provide a hedge against stock market volatility and contribute to your overall portfolio growth. Just remember to conduct thorough research and consider the associated risks before diving in. Lastly, keep in mind that staying informed is key. Regularly review your investment strategy and adjust as needed based on market conditions and your personal circumstances. By taking these actionable steps, rebalancing your portfolio, diversifying into safer assets, and exploring alternative investments, you can better navigate the challenges of a market crash. Remember, the goal is to protect your hard-earned savings while positioning yourself for future growth. So take these strategies to heart and start implementing them today to secure your financial future. As we navigate the turbulent waters of a market crash, it's crucial to recognize the emotional toll it can take on us. Financial planning isn't just about numbers, it's deeply intertwined with our feelings and mental well-being. When the market dips, anxiety can creep in, leading to panic decisions that may jeopardize our long-term goals. I've experienced this firsthand. During a downturn, I felt the urge to sell everything just to regain a sense of control. But that impulse can be detrimental. It's essential to acknowledge that stress and uncertainty are natural reactions, but we must find ways to manage them effectively. One of the most effective strategies is to maintain a long-term perspective. Remember, investing is a marathon, not a sprint. Market fluctuations are inevitable, and history shows us that markets tend to recover over time. For instance, during the 2008 financial crisis, many investors who held their positions saw their portfolios rebound significantly in the following years. Instead of focusing on short-term losses, remind yourself of your long-term goals. Visualize your retirement dreams and the lifestyle you aspire to achieve. This mental imagery can help ground you during turbulent times. Another critical tip is to avoid panic selling. When fear takes over, it's easy to make hasty decisions that can lead to regret. Instead, consider setting predetermined thresholds for your investments. For example, if a stock drops by a certain percentage, have a plan in place to reassess rather than react impulsively. This approach allows you to step back and evaluate the situation with a clear mind. Additionally, surrounding yourself with a support system, friends, family, or financial advisors, can provide reassurance and help you stay focused on your strategy. In summary, while market downturns can stir up a whirlwind of emotions, it's vital to keep a level head. By maintaining a long-term perspective and avoiding panic selling, you can navigate these challenges more effectively. Remember, every market cycle presents an opportunity to learn and grow. Embrace the journey, and don't hesitate to reach out for support when needed. Your financial future depends on it, and together, we can weather any storm. When navigating the choppy waters of a market crash, one of the most prudent steps you can take is to consult a financial advisor. This isn't just about having someone to hold your hand. It's about leveraging their expertise to make informed decisions that align with your long-term goals. Financial advisors bring a wealth of knowledge to the table, helping you understand complex market dynamics and how they impact your retirement plan. They can provide insights that you may not have considered, ensuring that you're not making reactive decisions based on fear. In times of volatility, the benefits of having a financial advisor become even more pronounced. They can help you assess your current investments, identify potential risks, and adjust your strategy accordingly. For instance, if you're heavily invested in stocks and the market takes a downturn, an advisor can guide you in reallocating your assets to more stable options, safeguarding your retirement savings. Their objective perspective can help you remain calm and focused, preventing you from making hasty decisions that could jeopardize your financial future. Choosing the right advisor is crucial. Start by looking for someone who specializes in retirement planning and has experience navigating market downturns. Check their credentials, and don't hesitate to ask for references. A good advisor should be willing to explain their investment philosophy and how it aligns with your goals. It's also important to find someone who communicates clearly and makes you feel comfortable discussing your financial situation. Remember, this relationship is built on trust, and you should feel confident in their ability to guide you through uncertain times. In summary, seeking professional advice during a market crash can be a game changer for your retirement plan. A skilled financial advisor not only provides valuable insights, but also helps you stay focused on your long-term objectives. Take the time to choose the right advisor, as this decision can significantly impact your financial well-being. So don't hesitate, reach out for help when you need it. Your future self will thank you for it. Adjust your retirement plan now. Consult experts to safeguard your future. Take action today